In the stock market, if you buy a stock, the worst thing that can happen is it goes to zero. You lose 100% of your money. But if you short a stock, if you bet it will go down, the risk is different. If the price goes up, you lose. If it keeps going up, you keep losing. Since there is no limit to how high a price can go, there is no limit to how much money you can lose. Your risk is infinite. We saw this with GameStop. Hedge funds lost billions in days. Now look at silver. At $79 an ounce, a handful of massive commercial banks are holding one of the largest short positions in history. They are betting against the metal. They are betting against the solar industry. They are betting against you, and they are wrong. We are watching a commercial signal failure in real time. The banks are trapped, and when they panic, they will become the biggest buyers on earth. This isn't a conspiracy theory. It is public data. Every week, the regulator CFTC releases the Commitments of Traders Report, the COT. It tells us who is long and who is short. It divides the market into two groups: the managed money, hedge fund speculators, and the commercials, the banks miners. Historically, the commercials are the smart money. They sell when the price is high to hedge their inventory. They almost always win. But look at the report today. The commercials are net short hundreds of millions of ounces, but they don't have the metal to back it up. Usually, a miner shorts to lock in a price for silver they will dig up. That is a hedge, but a bank shorts silver they don't have. That is a naked short. They are selling paper promises into a physical shortage. Episode 16. This is like selling fire insurance while the city is already burning. Traders have a rule: follow the commercials. If the banks are short, the price usually drops, but once in a generation, the banks get run over. This is called a commercial signal failure. It happened in palladium in 2019. The banks shorted it at $1,000. It went to $3,000. They lost billions. It happened in nickel in 2022. The Chinese tycoon Big Shot shorted it. It doubled in a day. The exchange had to close. It is happening in silver now. The banks shorted at $30, then $50, now $79. Every dollar the price rises, they face a margin call. They have to post more cash collateral. If silver hits $100, the losses become existential. They will have no choice but to cover. To cover a short, you have to buy the asset. Imagine the biggest banks in the world forced to buy millions of ounces of silver at any price, right when there is no physical metal available. Episode 016. That is the definition of a meltup. Why would they take such a stupid risk? Because for 40 years it worked. They could always print more paper silver, futures contracts, to flood the market and scare the retail investors out. It was a psychological game. But you can't print physical metal. With the Shanghai arbitrage draining the vaults, the ratio of paper ounces to real ounces has exploded. Some analysts estimate there are 500 paper claims for every 1 real ounce. This is a game of musical chairs. When the music stops, when the squeeze starts, there are 500 people trying to sit on one chair. The 499 who lose don't just lose their seat, they lose their wealth. The banks are currently sitting on 499 phantom chairs. We saw this psychology with GameStop, GME. Retail investors realized that hedge funds were short 140% of the available shares. That was mathematically impossible, so they bought and they held. They utilized diamond hands. They forced the hedge funds to buy back shares at $400 that they sold at $4. The silver squeeze is GameStop on a global scale. But instead of a dying video game retailer, the asset is a strategic metal essential for the future of energy. And instead of a few hedge funds, the victims are the systemically important banks. This makes it dangerous. If GME broke a hedge fund, silver could break the banking system. This is why the volatility will be extreme. They will fight back. They will change the margin requirements. They will halt trading. They cannot afford to lose. What happens if a major bullion bank fails because of this short position? You might think, good, they deserve it. But be careful. If you hold your silver in an unallocated account at that bank or in an ETF that uses that bank as a custodian, you are a creditor. In a bankruptcy, you are an unsecured creditor. This is the bail-in risk. The bank can legally take your unallocated silver to pay off its debts. You don't own silver. You own an IOU from a bankrupt casino. This is why the squeeze is a double-edged sword. It drives the price up, but it breaks the counterparties. To win the squeeze, you must remove the counterparty risk. If you don't hold it, you don't own it. How do you position yourself for the bank squeeze? The smart money playbook is aggressive. 1. Physical is the weapon. Buying physical silver removes supply from the market. It is the only way to squeeze the shorts. Paper trading just adds liquidity to their casino. 2. Call options, speculation. If you want leverage, buying long-dated call options on miners, episode 13, or the metal itself can offer exponential returns. But be prepared to lose 100% of the premium if they rig the game. 3. The exit strategy. A squeeze is a spike, not a plateau. When the price goes parabolic vertical, you sell. You sell into the panic buying of the banks. You don't hold a squeeze forever. You squeeze the juice and then you leave. Let's summarize the investigation. The banks are trapped in a short position they cannot cover. The physical market is empty. The price is rising. The smart money playbook. 1. Identify the trap. Read the COT report weekly. Watch the commercial short position. As long as it is high, the fuel for the squeeze exists. 2. Expect dirty tricks. Margin hikes, trading halts, media hit pieces. They will try to shake you out. 3. Hold the line. If you own physical, you have the power. They need what you have. 4. Sell the spike. When silver hits $150 or $200 in a week, don't get greedy. Sell some to the desperate banks and buy undervalued assets, land, platinum. The trap is set. The trigger has been pulled. This is the smart money wisdoms. The future belongs to the owners.